In today's dynamic financial landscape, navigating the complexities of investment can seem daunting, particularly for those starting their financial journey. With a plethora of investment vehicles available, making informed decisions is crucial to achieving your financial goals. Among these options, exchange-traded funds, ETFs, and mutual funds have gained immense popularity, attracting both seasoned investors and newcomers alike. Investing at its core is about growing your wealth over time. It's about putting your money to work, allowing it to generate returns and build a secure financial future. Whether you're saving for retirement, a down payment on a house, or your children's education, investing plays a pivotal role in transforming your aspirations into reality. However, the world of investing can often feel like a labyrinth, filled with complex jargon and a bewildering array of options. This is where ETFs and mutual funds come into play. These investment vehicles offer a simplified approach to investing, providing diversification and professional management. By pooling money from multiple investors, ETFs and mutual funds invest in a diversified portfolio of assets, such as stocks, bonds, or real estate. This diversification helps mitigate risk, as the performance of a single asset is less likely to significantly impact the overall portfolio. So let's embark on this enlightening journey into the world of ETFs and mutual funds, equipping you with the knowledge to make informed investment decisions and pave the way for a brighter financial future. Before we dive into the comparison, let's establish a clear understanding of what ETFs and mutual funds entail. Both investment vehicles share the fundamental characteristic of pooling money from multiple investors to invest in a diversified portfolio of assets. However, they differ in their structure, trading mechanisms, and associated costs. Exchange-traded funds, ETFs, are investment funds traded on stock exchanges, much like individual stocks. They track a specific index, sector, or commodity, providing investors with exposure to a basket of assets through a single investment. For instance, an ETF tracking the S&P 500 index would hold stocks of all 500 companies included in the index, mirroring its performance. Mutual funds, on the other hand, are investment pools managed by professional fund managers. These managers make investment decisions on behalf of the fund's investors, aiming to achieve the fund's stated investment objective. Mutual funds are typically priced once a day at the end of the trading day, based on the net asset value, NAV, of their underlying holdings. The key distinction between ETFs and mutual funds lies in their trading mechanisms. ETFs trade throughout the trading day, like stocks, allowing investors to buy and sell shares at real-time prices. This flexibility provides investors with greater control over their investments, enabling them to react quickly to market movements. ETFs have gained immense popularity in recent years, attracting investors with their flexibility, cost-effectiveness, and transparency. One of the most significant advantages of ETFs is their low expense ratios, which represent the annual fees charged by the fund to cover operating expenses. ETFs typically have lower expense ratios compared to mutual funds, as they are passively managed, meaning they track an index or a basket of assets without active intervention from a fund manager. This passive management approach translates into lower operating costs, which are passed on to investors in the form of lower fees. Another compelling advantage of ETFs is their tax efficiency. ETFs are structured in a way that minimizes taxable events, such as capital gains distributions. When investors sell their ETF shares, they are only taxed on the capital gains they realize from the sale. This tax efficiency can be particularly beneficial for investors in high tax brackets. However, ETFs are not without their drawbacks. One potential disadvantage is the trading costs associated with buying and selling ETF shares. While ETFs themselves have low expense ratios, investors may incur brokerage commissions each time they trade ETF shares. And mutual funds have long been a cornerstone of investment portfolios, offering investors a convenient way to diversify their investments and access professional management. One of the primary advantages of mutual funds is the expertise of professional fund managers who actively manage the fund's portfolio, making investment decisions on behalf of investors. These fund managers conduct thorough research, analyze market trends, and leverage their expertise to select investments that align with the fund's investment objective. Another advantage of mutual funds is their accessibility. mutual funds typically have low minimum investment requirements, making them accessible to investors with varying levels of capital. This low barrier to entry allows investors to start investing with smaller amounts and gradually increase their investments over time. However, mutual funds also come with their own set of disadvantages. One notable drawback is their higher expense ratios compared to ETFs. As mentioned earlier, mutual funds are actively managed, which incurs higher operating costs, including management fees, administrative expenses, and marketing costs. These expenses are passed on to investors in the form of higher expense ratios, which can erode investment returns over time. Another potential disadvantage of mutual funds is their tax inefficiency. Section 5. The Investment Face-Off. Comparing ETFs and mutual funds. When comparing ETFs and mutual funds, it's essential to consider various factors, including costs, risks, and returns. Let's delve into a head-to-head comparison of these investment vehicles. Costs. ETFs generally have lower expense ratios compared to mutual funds, making them a more cost-effective option for investors. However, investors should also consider trading costs, such as brokerage commissions, associated with buying and selling ETF shares. Risks. Both ETFs and mutual funds offer diversification, which helps mitigate risk by spreading investments across multiple assets. However, the specific risks associated with each investment type vary depending on the underlying assets held in the portfolio. Returns. The returns generated by ETFs and mutual funds depend on the performance of their underlying assets. Section 6. Tailoring your investment strategy, ETFs or mutual funds. The choice between ETFs and mutual funds ultimately depends on your individual investment goals, risk tolerance, and investment horizon. ETFs, with their low costs, tax efficiency, and trading flexibility, are often favored by investors seeking a cost-effective and hands-on approach to investing. Mutual funds, on the other hand, appeal to investors who prefer a more hands-off approach and value the expertise of professional fund managers. Section 7. Real-world applications, ETFs and mutual funds in action. To illustrate the practical applications of ETFs and mutual funds, let's consider a few real-world examples. Suppose you're a young investor with a long investment horizon and a high-risk tolerance. You're looking for a cost-effective way to gain exposure to the broad stock market. In this scenario, an ETF tracking the S&P 500 index could be an ideal investment choice. Now let's consider a different scenario. You're approaching retirement and have a lower risk tolerance. Section 8. Navigating the investment landscape, factors to consider. When making investment decisions, it's crucial to consider several factors beyond the choice between ETFs and mutual funds. These factors include your investment goals, risk tolerance, investment horizon, and overall financial situation. Let's delve into investment goals. Clearly define your investment goals, whether it's saving for retirement, purchasing a home, or funding your children's education. Your investment goals will shape your investment strategy and influence your asset allocation decisions. Now let's talk about risk tolerance. Assess your risk tolerance, which refers to your ability to withstand fluctuations in the value of your investments. Section 9. The power of diversification, a cornerstone of investing. Regardless of whether you choose ETFs or mutual funds, diversification should be a cornerstone of your investment strategy. Diversification involves spreading your investments across multiple asset classes, sectors, and geographies to reduce risk and enhance potential returns. By diversifying your portfolio, you reduce the impact of any single investment on your overall portfolio performance. Section 10. Seeking expert advice, a prudent step. Navigating the complexities of investing can be challenging, even for experienced investors. Seeking advice from a qualified financial advisor can provide valuable insights, guidance, and personalized recommendations tailored to your specific financial situation and investment goals. Section 11. Conclusion: making informed investment decisions. In conclusion, ETFs and mutual funds offer distinct advantages and disadvantages, making the choice between them highly personalized based on individual circumstances and investment objectives. ETFs, with their low costs, tax efficiency, and trading flexibility, cater to cost-conscious, hands-on investors seeking granular control over their portfolios. Conversely, mutual funds, managed by seasoned professionals and providing diversification and accessibility, appeal to those preferring a delegated approach, leveraging expertise for potentially higher returns. Ultimately, the optimal choice hinges on your investment goals, risk appetite, time horizon, and overall financial strategy.